This is Colin Cattell with Palisade Radio. Here on the line with us today is returning guest Rick Rule. Rick, it's a pleasure getting you back on.
Colin, thanks for the opportunity.
On our first interview back in September, we discussed the power of warrants, PGMs, and uranium. Last time we spoke, we focused on the optionality of a gold asset. Let's stick with this themed approach and touch on a topic you've been quite vocal on, and that is prospect generators. Could you explain to our audience what a prospect generator is and the risk-reward benefits you see that have led you to deploy capital in the sector?
Absolutely, Colin. A prospect generator is a team of people who exhibit substantial geological or commercial or political expertise and whose value proposition is to generate target concepts, geological target concepts, and rather than financing and drilling the targets themselves, farm out or bring in joint venture partners to do the heavy lifting. When I was in university a long time ago in the early 70s, we were taught in economic geology that about 1 in 3,000 mineralized anomalies became a mine. So the typical Howe Street or Bay Street investment proposition is that you take a 1 in 3,000 chance for a 10-to-1 return. That makes the lottery look like a very, very, very good deal. The truth is, in exploration, that they're not asset-intensive businesses. They're really knowledge businesses because every property thought of logically as a liability, the opportunity to spend money, not an asset, given the probability that they come to success. So maintaining one's interest in the knowledge base by farming out the interest in the project base is the rational way to pursue this business and exploration. And I have done this with some very certain success over the last 30 years. I have been involved, by my count, in something like 55 public prospect generators. I have participated in 22 economic discoveries and been the beneficiary of 15 takeovers. If you think about the concept of 15 major wins in 55 starts and compare that statistically with any other type of means of discriminating between exploration investments, the payoff from prospect generator joint venture business model portfolios of any other kind is unassailably better.
What specific qualities are you looking for in a prospect generator, and where can investors go to find these select companies?
I am looking for companies that generate multiple projects, but more importantly, farm them out. We're looking for companies that generate good enough ideas and have good enough reputations that the industry is a willing participant in their exploration activities. And you can measure this financially. The important metric is third-party expenditures on your behalf minus generative costs and general and administrative expenditures. Now, that's long-winded, but let's say that a joint venture partner is spending $10 million to earn into your prospect generator's property, and let's say that you have a 50% carried interest. What that means is that the third party is spending $5 million to advance your interest. If you are spending $6 or $7 million in order to get $5 million spent for your benefit, you are an inefficient generator. If by contrast you're spending $1 or $2 million in generative and general administrative expenditures to get $5 million spent for your benefit, then you can see the obvious leverage in the market. In order to track this oneself, all the investor really needs to do is pay attention to the published quarterlies and annual balance sheets and income statements of whatever prospect generators are present in one's portfolio. Or, of course, one could hire to do it for you.
And as an example, talk to our listeners about Legend Gold Corp. I'll have to add the disclaimer that you're now the largest shareholder of Legend, with around 28% of the company. What characterizes Legend as a prospect generator, and maybe touch on their recent announcement with Randgold as why Legend's model appears to be working?
Well, Legend is an interesting company, and as you suggest, we are large shareholders of Legend. The first attraction of Legend to us was the chairman, Michael Wynn, who we have known for so long that many years ago he worked for Global. We have been through many investments in project generation with Michael and his partner, Dr. Demetrius Pohl, who ran African gold exploration for BHP. I think our first interaction with those two gentlemen was in 1995 or 1996. Legend is the result of a two-company amalgamation and the acquisition of the exploration portfolio held by Endeavour Mining in West Africa. It's worthy to note that contained in a $20 or $25 million market cap is about $8 million in cash. And in particular, projects have seen about $250 million in exploration. So if you look at enterprise value, that's market cap less cash, of sort of 10 or $12 million. For 10 or $12 million, you're buying $250 million worth of historic data. That's the power of a bear market. You get to buy somebody's efforts at an astonishing discount to the money that has been placed on historic exploration. We're attracted to our database. We're very attracted to the team that's moving these things forward. In particular, with regards to Legend, you have 2 or 3 projects which are adjacent within trucking distance to existing rock-hungry mills that will be running out of reserves and resources. So we think we have a benefit here that we don't normally have with prospect generators. We think it's highly likely that the company will be able to deal off 1, 2, or 3 small projects to existing rock-hungry mills. And we suspect that after that, we will get the rest of the company for free, or actually less than for free. Being able to operate a database of $250 million in exploration expenditures for free in a prospect area that is as prospective as West Africa, with a team assembled that has 20 or 25 years experience in West Africa, we think is the type of risk reward parameter that prospect generation and prospect speculation is all about.
At PDAC, you made a comment that the optimism was maybe a bit too strong. How do you see things progressing over 2014 and into 2015 for the juniors?
I'm pretty confident that we've passed the bottom. I think we probably passed the bottom in the summer of 2013. I have been widely quoted, but I'll say it again, as saying that I didn't see the capitulation phase happen this time. I didn't see those laughably no-bid markets that we saw in 2000, and I didn't see the issuer capitulation taking place that we saw in 2000. But I guess it's not written in stone anywhere that there has to be a capitulation phase. And certainly the pricing that we saw in the summer of last year anticipated a market bottom. My own belief is that the market bottoms, or coming out of the market bottoms into a bull market, will lend itself to a saucer-shaped recovery, not a V-shaped recovery. The recovery that we've seen so far in December, January, and February was very much V-shaped. I believe that the market needs to consolidate the gains that it's enjoyed in the first part of this year. I don't believe that the market goes straight up from here. I think it goes sideways. But I do believe that 18 months out, we are going to be involved in a junior resource market, a junior resource bull market in earnest. It's important for your listeners who haven't been in the business for as many years as I, and I suspect that's most of your listeners, to understand that bear markets are the authors of bull markets. A market that's off 75% is a market that's 75% less risky. And it is my belief that the bear market that we were in was ugly enough that the bull market that it spawns will be pretty spectacular too. My suspicion is what we've seen so far is simply a dead cat bounce in the better issuers. They were so oversold that the absence of selling and some small amount of buying took them up fairly substantially. And that's indicative of what happens in the bear market bottom.
And what's your outlook on the metals at the moment? Do you see explosive moves or more of the saucer-shaped recovery unfolding there as well?
I think that the metals will need to consolidate their gains too, except for I would point out that there are any number of circumstances that could be anomalous in the metals markets. My own suspicion is that the base metals markets may continue to be soft because the recovery that we're in is a jobless recovery and a recovery without any capital goods investment, which is a different way of saying a very false recovery. With regards to precious metals, however, any exogenous shock that causes global investors to question the primacy of the US dollar and the primacy of the US 10-year Treasury as the world's sort of go-to financial instrument could cause sharply higher precious metals prices. I personally believe that physical precious metals, be they gold, silver, or platinum and palladium, are superior investment vehicles for a substantial amount of one's portfolio to the US 10-year Treasury. So my suspicion is that precious metals edge themselves up higher over time, with the caveat that rather than edging up, they could lurch up.
And Rick, is there anything that's on your mind these days in specific? Things are heating up in a lot of sectors here, as we've discussed. And maybe which specific sector is most exciting to you right now? Uranium, PGMs, gold?
Well, in terms of the price action in the metals, I like the PGMs. Unfortunately, it's very, very, very difficult to play the PGMs from an equity point of view. The established platinum and palladium producers are losing money at this price point. And they are faced with either challenging geology and engineering in Russia, where the Norilsk ore body becomes less palladium intensive as it goes to depth, or they're faced with social and political challenges in South Africa. In terms of exploration in the PGM sector, it's a very, very, very difficult metal to find, which is why it's produced primarily in Russia, Zimbabwe, and South Africa. Despite billions of dollars of efforts in ultramafic sectors worldwide, discoveries outside of those traditional producing areas haven't been successful. Certainly, we are seeing success in uranium exploration, particularly in the Athabasca Basin in Canada, which continues to attract me. But once in a decade, in my experience, you see a period in time where gold and silver equities are fairly priced, not cheap, but fairly priced relative to the gold price. And we're in one of those right now. My suspicion is that gold and silver prices are higher over the 5 or 6 years than they are now. And I think that gold and silver exploration equities, the better ones, are reasonably priced relative to the gold price, and that precious metals prices will rise. So I think the set of circumstances involved with being in parts of the precious metals exploration development business are at sort of once in a decade opportunity levels.
Rick, on that note, thanks so much for joining us today, and we look forward to speaking with you again later in 2014.
A pleasure, Colin. Thank you for the opportunity to address your audience.